Two things drive share prices really. I mean, one is sentiment, so how good and bad the market as a whole is feeling. So if people are feeling overly optimistic, the share price can go up a lot, and if they're feeling pessimistic, the share price can go down a lot. The other thing is fundamental value, which is driven by the company's outlook in terms of its profitability as well as by their assets and liabilities. So those two things are what are in investors' minds, are in our minds. So what happens when there's big shocks is there's consequent uncertainty. So that's where there's a big discrepancy that can occur between that sentiment factor and the fundamental value. And at the moment, what we're looking for is that differentiation, because volatility, when share prices move sharply upwards and downwards, that's really good for investors because that creates buying and selling opportunities, and that's what we're looking for because we're focused on fundamental value and how that differs from the from the ebbs and flows of sentiment. Volatility is on the rise, and that's because we've had a year where there's been a step change in the central bank's attitudes from one of tightening to one of loosening. So that's meant that interest rates are at record lows again, and they're stimulating the economy around the world. So basically, this has had a rocket effect under share markets. On top of that, you've had big events like in Australia, you've had the bushfires as well. We've had the trade wars. And most recently, a big X factor is this coronavirus. So these sorts of events are generally really create a lot of uncertainty. And when you get that uncertainty, share prices move in big directions. And I mean, some news is important. A lot of news is important, but you've got to look through and see what the effect on the underlying valuations of companies. And that's where we're at. There are buying opportunities that arise out of it, and that's why the upcoming reporting season, where we're going to be looking under the company's hoods and seeing what their financials are, has never been more important, because then we'll see what these businesses on the ground are saying in terms of the effect of the bushfires or the effect of the lower travel that's occurring globally, and also I guess the state of their balance sheets. So how strong are these companies, and how able are they to withstand the shocks? But I think over and above that, you've got the big share price movements. So we're looking at seeing where I guess the market's overdone, whether it's too much selling or too much buying, and that's why in the next month I think we're going to see a lot of opportunities to both take profits and to buy cheap stocks. When you do get these big events, I mean, it's important to look through and see what the strength of the companies. And obviously, Brexit is a big event, but when you look at the announcement of Brexit back in 2016, that was actually a buying opportunity. So the FTSE, the UK index, has rallied over 20% since then. So in the small cap sort of world, what we're looking for are the types of companies, or are companies that can produce growth, because that is why people buy small caps. And that growth comes from the operating leverage, because basically they've got a high fixed cost sort of base. And when you get those revenues, they go straight to the bottom line, so you can get exponential profit growth. So these are the kind of companies that we're looking for, and that's why we're here. I mean, classic companies in the growth segment include technology companies and technology-related companies like software companies, biotechs, or medical technology-related companies. And these companies, I mean, we've had some great successes in the past, like Afterpay, and right now we're catapulting ahead with Catapult. But there are other companies, like we've got 8 buy recommendations on these sort of companies, and they're good because they've got a limited cost base, but they've got a global market. So once they get IP accreditation and or validation, these companies can really make a big difference to your portfolio, and that's what you want. You want to have several irons in the fires where some of them can make a big difference to your portfolio's return. When to pull an iron out of the fire is a good question, because you don't want to get scolded, you don't want to get burnt. But I guess with the kind of companies we're talking about, with these growth companies, often there's a lot of momentum. So you have to really be pulling out, taking profits when you're on the crest of the wave. Like with the thing about growth is when you need accelerating growth. When even if a company is producing growth, if it's priced on a growth multiple and that growth is decelerating, you can get whacked. Like recently we took profits in Nearmap, and we're covering that one in this week's issue, but they showed decelerating growth. And that's what like basically the stock was over $3 when we took profits. Now it's about half that. So we're looking at that. So there's opportunities to get back into these growth stocks when they create a few missteps. It's all about the fundamentals, and that's why Under the Radar is so focused on the financials and on the valuation of the company. What we're doing consistently, as I mentioned just earlier, is taking profits. So you're always looking to take risk off the table. So, when companies have outperformed, you're not looking to hold on to them ad infinitum. You need to see where they stand at any point in time. Would I be a buyer right now? So that's one element. Another element is diversification. What we do is we have numerous model portfolios in the big cap and small cap segments. So we're showing people how to diversify their risk. And we've got portfolio managers who give tips and give good advice on setting up a portfolio. And we're also, I guess, providing the best ideas or the best buys. So we're making it simple for people to see what stocks we like most and why we like them right now.